Hello, my name is Yuhi, and we will discuss today the impact of the change in accounting standard on leases. This presentation presented by group number 6. As you can see in here, we have 5 group members. I will be discuss question 1 about the why new accounting standard triggered that covenant. And John will discuss question 2 of the new accounting standard, how or what impact on the previous contract. And Kingley will discuss about question 3, preference of the shareholder position. And they will discuss about question 4, shareholder position in that contract. Finally, Yunshik will discuss question 5 about the potential hypothesis, and he will finalize our discussion. Okay, let's start question number 1. Regarding to the question 1, we will discuss about why new accounting standard triggered that covenant. Before I answer this question, I would like to mention what is the debt covenant. The debt covenant is a restriction or a term that is to protect interests of the lender. And many of the ratio and some restriction include in the debt covenant, such as dividend payout, working capital, leverage, interest coverage ratio, and the restriction for the borrowing higher priority debt. And we also concerning about the debt covenant ratio. Generally, debt covenant is bank and lender use that ratio to determine future investment in that contract. Next slide mention about some of the problem between manager and debt holder. According to the positive accounting theory, we can see some of the problem in that contract. ACCT5015 mentioned 4 of the big problem between two relationship and solution. Firstly, we will discuss about the excessive dividend payment. In this case, manager acts behalf of the shareholder. So, if manager pay more dividend than their expectation or than their plan, probably dividend pay over than their expectation. So, it will decrease company's asset, it will affect company's financial statement. Therefore, one of the debt covenant, dividend payout ratio, will restrict the overpayment of dividend to the shareholder. Secondly, we can see the asset substitution problem. Some of the shareholder or many of the shareholder, they prefer to invest high risk project because high risk return high income to the shareholder. But that holder, they do not have any benefit from the high risk project. Therefore, that covenant restrict of the fund investment opportunity. Nextly, we can also see the underinvestment problem. In some of the circumstance, shareholder or manager, company, they don't want to take some positive NPV project. So, working capital ratio, they require to manager retain a certain amount of fund in their company. Therefore, it can be solved under investment problem. Finally, we can see the claim dilution. This one is when the company issues a debt with a higher percentage of debt, it could be occur in real situation. And therefore, that covenant of the leverage ratio will be solve this problem. Especially, we will focus about leverage ratio. Leverage ratio is really important that covenant in new accounting standard. Leverage ratio is how or how much company support by debt about their asset. So if their leverage ratio really high, it means company's debt is really high. So therefore, it will increase lender's risky and then lending risky. Above this problem and solution, we can answer our question 1. new accounting standard, especially debt covenant, it has the purpose. Firstly, debt covenant improve 11's faithfulness, and for the lender can check the regular financial update throughout the many ratios. And thirdly, maintain debt covenant term, and also we can focus about final purpose of the debt covenant, because this is the key point of this purpose of debt covenant. It can be reduced debt and low interest rate fund available. This is my answer for question 1. Thank you for listening my presentation. Now I'm handling to my next presenter. Thank you.
Thank you, Yuhi. There was a wonderful explanation regarding why could the new accounting standard trigger the debt covenant. Well, my part in this assessment is basically regarding the likelihood that the new accounting standard influence leases that companies would be entering. Before focusing on what the new accounting standard has got to do with leases, I would rather start with the current accounting standard and what the current accounting standard is been doing. The current accounting standard, basically, if the lease is a finance lease, the lessee would recognize the assets and liabilities in the statement of financial position. However, if the lease is considered as an operating lease, the lessee simply recognizes the lease payments as an expense over the lease term. Other point which is concerned with the current accounting standard is that they omit the material assets and liabilities arising of the balance sheet operating lease contracts. Some other point which, or even the limitation which drives the new accounting standard to come into force was like there has been some marginal differences in the contractual terms which thereby ends in claiming one lease as finance lease and the other lease as operating lease. However, similar transactions cannot be carried forward with similar accounting treatment. So that is one of the major limitations, so one of the major drawback of the current accounting standard, which drives into developing a new accounting standard which could deal with such factors. Well, it was really close to divide between the operating lease and the finance lease, and that was one of the reason a new accounting approach or a new approach to classify the leases as operating and financial lease was being put forward by the Australian Accounting Standards Board. Now I would like to focus something regarding what the new accounting standard has got to do with what the new accounting standard will be doing in relation with the leases. The application of this new accounting standard was basically to discontinue the operating lease classification, and that all the leases, irrespective of what the terms are, all the leases just except the short-term leases in the sense less than the leases which is of less than 12 months period. All the leases needs to be recorded in the balance sheet. Other factor regarding the new accounting standard was like replacing the rental expense, in which the lessees would recognize the interest and amortization expense as interest expense, which actually decreases over time. Other point which I would like to take your attention to is, there will be a question from you guys, okay, if the company is not gonna have any such operating leases, or all the leases are to be recognized in the balance sheet, how about a company is having a leases which is less than a period of 12 months or short-term leases ineffective? Based on our research and our studies, we have concluded that the short-term leases, or the leases which are not actually recognized in the balance sheet, needs to be recorded in the notes section and not in the balance sheet. This is all regarding the new accounting standard. Well, it has been, this was actually from 12th of June. The new accounting standard is going to be effective only in 2017, but this was one of the report which stated like from 12th of June, all the leases irrespective of their like finance lease or operating lease that needs to be recorded in the or recognized in the balance sheet. Well, that's all from my part. Now I would like to welcome my group mate Lee to explain regarding how the debt holders will prefer more leases to be recognized in the balance sheet, or it needs to be kept off from the balance sheet. Thank you.
Hello, my name is Keyin Li. I will talking about question 3. So, in my opinion, the debt holder prefer more lease on the balance sheet. Next slide, please. Firstly, I'm talking about two kinds of the accounting method of the lease: financial lease and operating lease. The operating lease we treat like running. The lease payment we treat like the operating expense. So the asset being leased stay off the balance sheet. However, the financial lease we treat like loan. So the asset we treat like be owned by leasing. So it stay on the balance sheet. In my opinion, the debt holder pay for the financial lease because on the financial lease they can transfer all the risk and benefit to lessee. Maybe the legal owner still are debt holder, but the lessee should pay all the expense, such as insurance, tax, because of the transfer the ownership. So the lessee is the owner of the equipment. So the lessee should also claim the depreciation expense and the interest expense. So the debt holder pay for more lease on the balance sheet. The second reason is if you put more lease on the balance sheet, the debt holder can evaluate the company better. So they pay for the fully disclosure because they need information from the balance sheet to make decision such as lending decision, and they need more information to judgment company about the capital structure and ability of the repay and the risk running. So they need the information on the balance sheet rather than disclose in the notes. According to some banker, they believe the lease contract will have significant effect on the credit rating assessment and the interest rate charged. So they believe if the company put all the lease on the balance sheet, the company's liability and asset will increase, so the leverage of the company will increase. When he provides the finance to the lessee, the risk will increase, so they can lower the credit rating for the company and higher the interest rate to charge the companies. They also have other reasons the debt holder pay for the list on the balance sheet, such as if the lessee recognize the liability recognize the lease on the balance sheet, it means they recognize the liability to pay the lease payment to the debt holder. The last reason is it can help the lessor to recognize up for the profit and loss on the lease, and the interest income on the account receivable over the lease term. So this is the 4 reasons why the debt holder pay for the more lease on the balance sheet. Now I will hand it to the D. She will talking about the question 4. How about the shareholder think about the lease should or should not put on the balance sheet? Thank you.
Thank you, Connie. Based on her presentation, we know that the debt holders prefer to put the lease in the balance sheet. How about the shareholders' opinion regarding to that? I'm going to talk about this topic in 3 parts. First, it's going to talk about the off-balance sheet, and then give the view of shareholder, and then the reasons will be presented. First, let's look at the off-balance sheet. it doesn't need to recognize the lease in the balance sheet. That means the lease is not capitalized as asset and a liability. The off-balance sheet shows there is no depreciation, no interest expense, and no liability. So it can be seen that the shareholders prefer the lease to be recognized off the balance sheet. Here is three reasons to show why shareholders prefer like that. First one is no effects on leverage or liquidity ratios under off-balance sheet. If we put the lease in the balance sheet, the liability will be increased and the debit to total asset will be increased as well, which means the leverage remains higher. The leverage is much important for a company to get additional financing in the future. For example, the bank decided to lend some money to a company. It requires to consider many aspects, which included the leverage, to rate the credit level of a company. The low ratios helps the company to get expected loans in the future. Second one is keeping the lease in balance sheet will result in lower net income. As we all know, treating the lease in balance sheet will generate the interest expenses and the depreciation expense over the life of the lease. The rental payment under off-balance sheet is equal to the expenses under balance sheet. However, it should be noticed that in the very early stage of the lease agreement, the depreciation and the interest expense under the balance sheet is much higher than the rental payment expense under the off-balance sheet. The highest expenses cause the lower net income, and the lower net income would result in the lower return earning, which is a component of shareholders' equity. As a result of that, the shareholders' dividends will be decreased as well. And the last one is keeping the lease in balance sheet will result in lower rate of return. We need to know that the rate of return consists about the net income margins, the asset turnover, and the leverage. The expenses, such as the depreciation expenses and the interest expenses, would result in the lower net income, which means the lower net income margins, and the high level of the asset cause a decline in the total asset turnovers. So these three factors will result the effects of the lower rate of return. Those are the three reasons to support my view about why shareholders prefer to keep the lease of the balance sheet. And now let's welcome the next person to present question number 5. Thank you.
Thank you, Dee. My name is Yun Sik Jang. So take the points what our group members have presented so far into the consideration in relation to our assignment case study. It falls then to the positive accounting theories, which is that question 5 is asking. So I'd like to introduce three types of positive accounting theories which have been widely used in accounting society. They were developed by Watson Zimmerman in 1978. So, the first one is bonus plan hypothesis. So simply, the managers will try to maximize their reported earnings for the highest their remuneration. So based on the accrual accounting procedures, they may use depreciation method, inventory costing method, and discount rates method. Secondly, which is highly potential for case study, is debt covenant hypothesis. So some companies have current year's earnings to falling short, which is having problems of against the debt covenant benchmark set up by the lessors. Then the lessees will try to bring the earnings from future period into the current period. So next one is political cost hypothesis, which is opposite to the first two hypotheses. The first two hypotheses were basically bring the future period earnings into the current period financial year to maximize their earnings, whereas the last one, political cost hypothesis, is deferring the current period earnings into the future period to show to reveal their lower earnings in their financial statement. So our second slide will narrow it down in relation to our assignment case. So expectedly in 2017, new accounting standards on lease will be in effect. Then firms have to recognize all the leases on the balance sheet and disclose all the information on the note. Then there will be more possibilities that the firms violate in debt covenants which was set up by the lessors. So then the managers will select the accounting policies within the opportunistic behavior range to manipulate their net incomes to reduce the possibility of technical default. So in this assignment case study, the highly potentially the debt covenant hypothesis would be used. So to sum up, firstly we talked about the what the debt covenant ratio is, and that could ease the problems that we had on the previous accounting system. And secondly, that would impact on the company's case by case. Obviously, the management will try to use positive accounting theories to reduce their to benefit themselves. Thirdly, the new accounting standards on lease would help debt holders, whereas the shareholders would not want to that in effect, because that would have negative impact on shareholders. And lastly, as I said before, highly potential or hypothesis would be debt holders. Thank you very much. This is all our Group 6 presentation. Thank you.